Boy, it seems like Groundhog Day today. For a sixth day in a row, we start off to the downside with an opening gap to the downside. I talk about what's weighing us down every day at the open in today's video. I'll break that down. We also then bounced, and we continued to bounce up, but today was a little bit different than the previous 5 days of this pattern. So I'm going to break that down too and see, okay, how does that impact what the market forecast says? What are our expectations now that we got more of a near-term pullback that we were talking about yesterday? What's the expectations now heading into the end of the week and early next week? And what does that change from our intermediate term expectations? In this bearishness, there's one sector among others that's kind of leading the charts to the downside. A lot of volatility. There's a lot of stocks kind of breaking down within that sector. That's where we come up with today's trade idea. Let's go ahead and get started. Today is Wednesday, November the 15th, 2017. This is the Market Outlook video. My name is David Settle. Thank you very much for watching tonight. Welcome to those that are watching for the first time. I'm very glad you found us. Keep coming back day after day for more. Join our community here. Subscribe to the YouTube channel. Hit that red button. Hit the thumbs up to let me know that you like the video. Comment on anything that stood out from the video today. In the description, you'll see 2 links. The first one is to join our email subscription newsletter. The second one is to fill out a survey on a new venture that my Brandon Van Zee and I are looking to start together. We want your input. You can also follow me on Twitter at DavidSettle42. While you're there on Twitter, go to my handle, scroll up to the top. I pin it at the very top. You can like and retweet today's market forecast tweet. We hit the exact same numbers last night as the day before, so that's why I didn't change the image there. So if you want to let me know and let others know that they should check this out, those are the 2 things I want you to do there on Twitter. All right, one more quick note too on the survey that I mentioned with the link down in the description below. We are almost done with the survey. We've almost achieved the number of surveys we were looking for as a goal. We're about 100 short of that. So again, if you are interested in joining us as we launch our new investor education venture, we want to hear your input. We want to build what you want to have, and this is the best way to give us that input. There's 8 questions. What you want to do is not only fill that out, let us know, but by filling it out and putting your email address in here, we want to reward you for helping us. We want to kind of, as a token of appreciation, give you a unique offer for our services when we do launch early part of next year. So the only way you can qualify for that is to fill out the survey and then leave your email address. If you don't, because the offer will go out through email to the email addresses that we have collected through the survey. So if you feel like, you know what, I'm not sure if I've answered that survey, I don't know if I put my email address, then go ahead and send us an email or join that email subscription newsletter that lists there. But send us an email, settlevanzee@gmail.com. We'll make sure that you're on there, or go ahead and just fill out the survey if you haven't already. All right, well, let's take a look at the S&P 500 first with the market forecast indicator here from this trading platform. And you can see we've had another down day, so we've had 4 out, well, let's see, what would this be? 5 out of 7 down days, 4 out of 5. But you notice that only 2 of the 5 are filled in candles, which means that we closed lower than where we opened. These other 3, we actually closed higher than where we opened. And as I mentioned before, and I mentioned this in this tweet, let's see, let's go to my Twitter handle here. And again, it's at DavidSettle42 to find my Twitter handle. But you can see I posted earlier this morning that there's a 6-day lower opening gap streak. So 6 days in a row we gapped down every single day, and then every other day after that was up. So one thing about that, in fact I tweeted that out earlier than that. There we go. That was the first one. But then I tweeted out later that every one of those opens was lower. Sometimes it was just slightly, but it was lower than the previous day's open. And then you notice, just as we did on all the rest of the rallies, we came all the rest of the gaps. Even if we came down a little bit more after the open, we rallied. We rallied almost immediately in the buy the dipper. So it kind of made me think, seems like we've been living this day over and over and over again. So that's kind of where we're at on the S&P. We stopped right at that 62% Fibonacci retracement level. We got a red arrow on the moving average, which means we crossed below that 6-week moving average. First time we've done that in a long time. We talked yesterday, if you recall, we talked yesterday on the S&P and on the Russell that if we were going to continue this little decline, short-term decline, where could we end? Well, the S&P 500, we talked about coming down into this area, maybe even producing a, to that 62% level and producing a red arrow, and that would bring the near-term line below 50. We also talked on the Russell 2000 that we could come down to this old high point, this Fibonacci retracement, which is at 38% on this intermediate line, 50% of this like really significant kind of outlier move here. We came right down on an intraday basis and formed another long lower shadow. So as bearish as the Russell's been, look at all those red arrow or red candles here. As bearish as it's been so slightly bearish. That's why our market sentiment line is still very elevated despite all those down arrows. But you notice the other reason why it's still very elevated is we're getting a lot of longer lower shadows here, and that's when you're tanking, you're closing at the lows of the day, and you notice that's what brings market sentiment down and gives you that bearish posture that stays for a while. Is that so we haven't been getting that, and that's why we're still very elevated, and that's why we're not really like significantly bearish here on the Russell 2000. Of course, the S&P 500 it's about as weakly bearish as you can get because it's at 75. It's bearish because we crossed below 80, but it's weak. That posture is weak. So keep that in mind, that we can turn right back up from here and get right back to strongly bullish just like that. So we don't go from strongly bullish to strongly bearish, because to get to strongly bearish you have to be down here. And a lot of people think that, well, if we're really rallying, as soon as we turn around, man, it's down the tubes. Well, no, you never go from strong bullish postures to strong bearish postures. It always goes from strong bullish to weak bearish, from strong bearish to weak bullish. Now, granted, that weak bearish can turn into something more once it crosses below 50, but obviously we're not there yet. So we can turn right back up and get right back to strongly bullish, just like that, right? Especially if that near-term line bounces from here. If we would have closed the lows of the day, you actually would have had a really ideal buy signal, bounce signal, and that you would have had the near-term line was lower, it was down closer to 25, but still it would have been between 20 and 50, which is an ideal bullish scenario for the blue line. The last near-term low point was right here, so it's a slightly higher near-term low, so you can call that a bullish near-term low. And the momentum line when we were down near the lows was also below 20, giving us that bullish intermediate confirmation signal, which would have stayed up here, could have stayed up here. Now, granted, the intermediate line ended up coming down, so that nullifies that signal. But we briefly had, because of the way things were at here, we briefly had the type of signal that we wanted. Ultimately, we have a weak bearish posture. It's not the perfect buy signal, but the near-term line is forming a potential bullish near-term low. It is a weak bearish posture, so we have to, and we did dip to the 62% Fibonacci level, so we can bounce. There is expectations that we can bounce here, just because of how, because it got to the 62% level, because the intermediate lines below 80. See, all these other near bullish postures here, the intermediate posture was bullish, so we bounced right off of that one, and we bounced right off of this one. Here, are we going to bounce up to new highs? Definitely anything could happen. We wouldn't expect it to bounce up to new highs because of the posture change, right? We expect it to bounce because of where the near-term line is and that potential for bullish bounce there. And the way we'll know that that's not going to be the case is if it comes back down and gets down below 20. The near-term line, the blue line, gets down below 20. From a support level, you're going to probably have to get down below, this 25.50 area and close down in here. And close down. See all these long lower shadows. We were flirting with those all day. 25.66, 25.66 there, 25.66 there. I mean, all three of these, and we close at 25.64. So, technically 2 points below those lows, so you could say breakout. But in reality, you're still at Fibonacci support, so you really need to close down here and again close at the low, if we're going to say, okay, now we're expecting things to get more bearish. Now, not like, again, fall off the cliff bearish, but we're expecting more of a bearish intermediate run. Until we see that, we expect the bounce, as the short-term bounce. Just don't expect it to go up to new highs, and if it does, slightly new highs with the potential for a divergence because that weak bearish posture, the elevated market sentiment, and the deeper pullback. See, ideally, you would have pulled back and bounced off this 38% Fibonacci level. Here, that wasn't the case. From an intermediate posture, even now, you notice all we did was we got down, so we had this bullish posture. Now, we're not saying it's over yet because, yes, we are bearish, but we didn't cross below 50. So this intermediate run's technically not over yet. But you can see how, if it is, like, you know, if we do pull back below 50, we're probably going to have to break below here and make a run towards that 38%, the halfway mark of this run, right around that 25.25. There's where we're going to start looking for another area of support for a bounce, intermediate bounce at that point. All right, when we take a look at the long-term view, you can see the pullback here. You know, again, very muted compared to the last pullback, you know, multi-week pullback that we had. So we might end up with a down month. That was another thing I tweeted out here this afternoon. You notice the 12-month streak here of all greens. We've never had a full calendar year with no reds, at least since 1988. So it's been, I mean, some of these years we've had more reds than greens, but still bullish years, right? And here we've had, you know, they've been smaller, but we haven't had a, you know, above 3% return in any of these months. You see some of these years we've had 7% coming off a loss, 4% coming off a loss, 7% there, 5% there, 4% there. You know, so it's been these declines that have produced the bigger returns. But we haven't had any of those kind of bigger returns this year. So it's been small, but it's been every single month. Could this be the month that we get it? Well, you know, again, here the precedent is a couple of weeks, pull back to that 50% and go. And you can see from a 3 green arrow standpoint, we got 3 red arrows. When you get 3 red arrows and a strong upward trend, that can be considered a kind of a buying opportunity. You know, the idea being that, you know, you can put a stop order below that low point. You know, we got the day here where we got that 3rd red arrow. Below the moving average usually is a 3rd one out of the 3 that comes. Here it happened to be the stochastics as well. But you get that 3rd red arrow and we bounce. And a lot of times the reason why is because your MACD is still bullish. It's still above 0. Now it's getting closer to 0. The MACD, the 8 and the 17-day are both falling now because we're below both of them. And now we, you know, again, we close below the 32. But they're still in that right order that if we bounce, we can get right back up and keep that MACD higher. And that's, you know, we've seen that happen in the past before. So until, you know, again, especially on strong upward trends, because it's still positive, and the stochastics, is, while it is bearish, is also still above 50. So we're getting pullbacks, not surprising on these technical indicators. But we're kind of at that point right now where we can definitely bounce here. Now, are we going to bounce and get that MACD back above its moving average? Probably not. Usually when we're making this long extended run, we make that run down to 0. So I wouldn't expect this MACD to bounce back up above its moving average, but I wouldn't be surprised if it bounced back up to the moving average, and this bounced back up and was grinding higher towards maybe a slightly new all-time high, but most likely in this area here, before we turn back down and continue to grind to the downside and let that MACD get closer to 0, let these lines get closer to each other, and then maybe more of a breakdown that will get us to the 200, you know, or at least below the 50, to get below that 50-day moving average, which you can see we just haven't been significantly below the 50-day moving average like some of these times for a while. I mean, we've only been below it twice since the election, briefly, both times. So now again, we're strongly, another reason why I wouldn't expect us to like break down to the 200 right now is because the momentum is still very strong. Even though it's rolling over, it's still very strong. All right, when we look at the intraday chart, you see lower highs, lower lows. You see that lower open again. So day after 6 days in a row of lower opens. We'll look at that more here when we look at the different asset classes. But regardless, every morning we start with weakness, usually stemming from what's happening overnight. Then we rally off of that low, off those lows, And in this case today, what makes today a little different than other days and less bullish than some of these other days, so we didn't close at the high of the day. The high of the day came in the middle. We closed back down. Now, it wasn't bearish either because we didn't close at the lows. We closed in the middle of today's range. We closed around yesterday's low point, still up above last week's low point. And just for some perspective, because I know, like, man, when we start selling off, there's doom and gloom. You know, here's this 250, 250-50 area here. You know, we broke down below that this morning, but you can see how we're still kind of holding it right now in that area. Once we break back down, let's say below 256 and a quarter, then okay, now we're going to start like testing the 4-week range. And see, there's the 4-week low point. Remember, we don't get bearish. There's no reason for us to be significantly bearish until we're breaking the 4-week low. Now, the 4-week low, you know, if we continue to muddle, if we bounce off of this and start to muddle up here, the 4-week low in another week is going to be right there. It's going to be today's low point. And then again, you know, we might not break up to new highs. And if that's the case, we're looking at about a 3+ point range, which is tight. And when it gets tight, that's when you start to get the breakdowns below that. And again, the moving averages start to flatten out. They get tighter against each other. That MACD gets towards 0. So I wouldn't be surprised if we don't kind of bounce off of this, give the bulls that last little gasp. You know, those people that bought right here and now are worried about things, and they're like, oh, can it go back up? And then they'll be happy here, only to see their hopes and dreams all go down the tubes. Right? Again, not necessarily into a tanking market, but at least into a more bearish market than probably a lot of people are used to. I mean, there might be some people right now in the markets, at least that have been in the markets this year, that have been paying attention more now this year than they ever have. There might be some people that think a 1% drop just never happens. And once it does, it's going to be like the end of the world. So, and again, don't be surprised if we don't start seeing doom and gloom type articles. But just know whenever you do see that, remember this, and also remember too, this. You know, we've got a long ways to go before things are really hitting the fan. If we were to now to kind of zoom this out, you see today's volume starting to ramp up. 80 million. The trading range 1.5 points, almost 1.6 points. Again, remember too that the high today 257.22. The close yesterday 257.73. So there's a gap there, which is about what, 73 to today's high 22. So about a 0.5 point. So add another 0.5 point onto that range, essentially, because we didn't fill in the gap completely this morning. Add another 0.5 point in there, so you got about a 2-point range. Again, with 80 million shares traded, you know, even at 1.5 points, it's right in that area where we don't want it to be from a bullish standpoint. And 80 million is also right in that area, because neither one of these numbers, they're both above the averages, but neither one of them are extreme. So when the selling is kind of orderly like that, then it tends to last longer. You know, you can see even here and over here, when we get the one big down move like this one from an all-time high, then we bounce almost immediately off of it. So if it's more orderly and we get some kind of, you know, nice little move higher in these ranges, you can see it happened here, it happened here. These lines came up. Then it can last longer. Now here it just lasted about 1.5 months, and here it lasted about a month. But at least it was long enough to provide some buying opportunity. It's a more significant buying opportunity here and here than what we have right now, right? So we get a little bit more of a pullback, a little bit better of a buying opportunity. But again, I don't expect that. And even if we do bounce up the next couple of days on a near-term basis, if we continue to have kind of bigger volumes and bigger trading ranges, but not extreme, then that will still kind of keep this bearish story kind of intact. That where we might get more of a bearish intermediate posture. Finally, volatility, you notice it's gotten up to some highs. You know, this is about the top end of the range over the last few months. If you take a look on an annual chart, you can see we've even gotten up to 14 and 15. So we're not threatening like some extreme highs in volatility. Before last year, the peaks were at the 20 level, 20 area. Before that, you know, in the early part of 2016, the last real significant bearish move that we had, you can see volatility go all the way up into the high 20s for a while, for multiple days. So, you know, we're kind of in the mode right now where it's testing recent highs and may get up to 15. And again, if we get more of an extended bearish run, intermediate run, that's not necessarily breaking 200-day moving averages, but starts to gravitate below the 50 for a while at least, then you'll probably see volatility in this range. If you take a look at the, whoops, not this one here. If you take a look at the ratio of the VIX to that VXV, the 3-month volatility, you can see we're kind of at that top where, at that point between 90 and 95 is a neutral range. So we've broken above 85, but we're still in that 90 area where we can get a short-term bounce, right? Hit some resistance. But if we were to kind of bounce up here and get a move up to 1, like we did over here, again, that will coincide more with a more longer bearish extended run. So you can see multiple signs kind of saying, okay, now's a good time for a quick short-term bounce, not to necessarily new highs, if that maybe slightly, and set up some divergences. But again, because we've been so bullish for so long, the conditions are there for a more extended bearish run, not one that's going to change the long-term trend, but one that might put us below the 50-day moving average, at least for a week or two, before we start to maintain. And again, just like on the daily chart, where things don't really get bearish when the MACD for the 8 and the 17-day moving averages is so high. It's the same thing with the 15 to 200. The MACD is very high right now. It's got to come back down close. It doesn't have to get all the way to 0, but it's got to come back down, get to that 50, maybe even that 25 area before things really get bearish. And so, which means that, those lines have got to flatten out. So we'll come down below the 50 potentially by the end of this year, bounce back up, maybe start flirting around the 50, because you start to get a lot of arrows on this long-term chart. You see how you start to get a lot of arrows here before things get really bearish? We haven't got a lot of arrows yet. So if you're looking for things to get like this, you got to be patient. We're not going to have this kind of move in the next few weeks or by the end of the year, according to past precedent, right? But we could get this kind of move, heading into the end of the year, where we start to flirt with the 50-day and go up and down and get some more volatility. That the markets won't go anywhere, but you'll start to see some higher volatility. You'll start to see some more trading opportunity. You'll see a lot of sector rotation, and that's why some of the trade ideas we talked about in the last couple of days, in terms of safe haven trades, they tend to hold up better when things start to get a little bit more volatile. All right, really quickly, before we take a look at this, I want to take a look at the calendar. We had a lot of economic data out on the calendar. The CPI, remember the PPI on a year-over-year basis is growing. The CPI on a headline basis did not come down year-over-year, but the core did go up. The headline did come down. The core did not. It went up on a year-over-year basis. So inflation's rising, core inflation's rising. We had a lot of the other economic data. The Empire State Manufacturing came down, but still, in and of itself, is a high level, just not as high as it's been. Remember, this is a sentiment survey. This is not actual manufacturing data. So it's that soft data versus hard data thing showing up here. Retail sales was slightly better than expected. Still not nearly as strong as it has been, but holding up. You can see the year-over-year growth down just a little bit, but still at high levels. So still holding and doing pretty well there. Business inventories. The business inventories to sales ratio, as this drops, then you have to produce more, right? That's a positive for manufacturing. But you can see it's still kind of heading down, which means that the manufacturing, while the sentiment might be pretty bullish, there's not a whole lot there. We can see there's strong sales numbers, but still the manufacturing's not outpacing it. So you see this ratio is coming down. It's a good sign eventually for manufacturing as it's coming down. Treasury International Capital, this kind of shows how much money is coming in. So when you have a trade deficit, you have a lot of dollars leaving because we have to exchange our currency for other countries' currencies to buy their products. So in order to balance the accounts, you need money, foreign currencies coming in, and exchanging them into dollars, so we don't have a deficit there. And so you can see that's what this is. So when foreign demand, so that's, even though we run a trade deficit in terms of goods and services, we usually run a pretty large surplus to offset that in terms of foreign securities, foreign demand for our securities. So in order to buy U.S. stocks, U.S. treasuries, they have to exchange their currencies into U.S. dollars in order to buy them. So this needs to be up and strong and positive to be able to offset the around 40 billion, in that area, 50 billion trade deficit that we have, and you can see good. So from a big picture standpoint, you can see pretty decent economic indicators. Not, we're still, not going back up anymore, but we're still strongly positive. The odds of a rate hike which would be the red line. The purple line is odds of no rate hike in 2018 as of June. Continues to drop, whereas the odds of one rate hike is rising. So we'll get at least one. According to what the market's saying, there's a pretty good chance we'll get at least one by next June, after the one that's already baked in the cake that we're expecting in December. GDP estimates were updated here today, and you can see they'll be updated again on Friday, but you can see a little bit less, but still 3.2%, coming off a 3% advanced number for the third quarter. So pretty decent, odds. Remember, the inflation data is up over 2%, so we're only looking at about a 1% real return of GDP, and this is only in a quarter, and it's annualized, but it's only for a quarter. We haven't had a year of 3% in a while. A full year. But we have to start somewhere, and so far so good. The precedent for this is to continue to head down as we head towards the actual release, which we have a few months before. So we'll kind of keep our eyes out on that one. But now I want to take a look at this chart. This is the chart here where we kind of I want to analyze the 6 down days that we had. And you can see, let's start with this one right here. So there's our first opening gap. The white line is the S&P 500. You see how the open here, where my cursor is lower than the close. But we did finish at the high. So we'll take a look at that, and you can see down here the international stocks were okay. We were just barely down. It was mostly energy and Russell 2000 related there. If you take a look at this one too, and take a look at what led the way lower there, then it became an international story. Small cap stocks were still bearish, but you see how it was an international stocks that opened the morning lower than anything else. So it was an international thing. The market's kind of getting a little bit more skittish internationally. You can see here, if I were to take a look at the next day, again, there's your white line, the S&P 500. The Russell was up. It started the morning higher, but the S&P was down. Look what was the most down. Now, granted, bonds weren't doing so good, but it was international stocks, again, that started the morning weaker than anything else. We'll come over here to the 13th, and we'll take a look really quickly at what started the day. Small caps were down, but so were international. Emerging markets, developed markets. You can see how a recurring theme here, that it's really kind of the international areas that is leading the weakness. Here was energy related, so that brought it down. International stocks had a little bit of a reprieve. Energy related there, big drop early in the morning on this opening gap. But then, of course, right here, again, international stocks. Small caps down there too, but international stocks lagging behind the S&P 500. So just about every day, there's weakness overnight in Asia or in Europe or both. And it's bleeding over into the U.S. Open, but then every single day we've rallied off those lows in the U.S. trading. So right now what's happening is, remember, if we go year to date on this chart, the best performing asset classes over the course of the year have been those international stocks. So in terms of like having gains to lock in and profit taking, it's going to be in those areas. There's your emerging markets, there's your developed markets, there's the S&P 500, and of course the Russell's been having a down year relative to the S&P 500. So these markets are starting to turn, and you notice the developed markets has already formed a lower low. Emerging markets is close to forming a lower low, whereas the S&P 500 is not. The Russell 2000 is already also below this area, the low point of this area too. So these areas are starting to show weakness before the large cap, and that's why we're starting to see. So if we're going to have any fundamental basis for a more extended bearish intermediate run, it's going to be because of profit taking in these international areas that have just been killing it. Look, the emerging markets is up double what the S&P 500 is this year to date. So there's going to be some profit taking there and coming out, and you can see what's doing well, what's been rallying since this point here. Let's see, right about here is where emerging markets internationals started to outperform, you can see the gold and treasuries are the only things that are, well, the treasuries are up. Gold is down just a little bit while everything else is down, and crude oil is down too during that same time. So you can kind of see the impact on where money is moving into. Small cap or large cap stocks are up there too because they tend to be more of a safe haven compared to, say, small cap stocks right here. Take a quick look at how the different sectors did today, and you can see again the biggest sector performance and over the last couple of weeks heading into today were these safe haven areas: utilities, staples, real estate. Well, they pulled back a little bit today. The S&P down. Financials held up well. Financials, you can see healthcare doing pretty well there too, and you can also see here consumer discretionary and outpacing, and some of these others are down. So what this tells me is it's we've had, if I were to zoom back out now, over the last, heading into this, you can see what's been lagging. There's your healthcare, there's financials, consumer discretionary has been okay, there's your winners. So flip that. So basically today was, with all that news, doesn't matter. Today was just, okay, take some money out of what's winning and buy into some of the things that aren't doing as well. And again, short-term bounce. You might get some bounce into some of these areas, but not necessarily the new highs. We've seen if we get more of an extended bearish run, we've seen what will tend to hold up well and outperform. Even if they don't get gains, we've seen that they outperform during any kind of pullback like that. Alright, so for our trade idea of the day, if we're going to look to put a little bit of bearishness in that portfolio and any kind of pullback, then we know energy had been doing very well, but it's been one of the more volatile sectors here during the last few days, and ExxonMobil is a good picture of that. A lot of the stocks have been dropping within that sector, within XLE. But you look at ExxonMobil, here's a situation where you had 3 red arrows, that you broke through some resistance at 82.5. You kind of had some strong volume on the earnings. You didn't get 3 green arrows. You didn't get the arrow here on the MACD. We were kind of hovering a little bit above it, and then we got a red arrow on this upward trend. 3 red arrows, still holding 82.5 for support. You think, okay, we're going to bounce. Didn't bounce. In fact, we came down below that 82.5 again with a vengeance. And so, not a whole lot of volume, but you don't need a lot of the volume on the downside. You need to support that. You need a buying momentum on the upside to break through the resistance. So quite a move to the downside here, breaking below Bollinger Bands as well. If you take a look at the market forecast on this, you can see the intermediate line's fallen below 50. With the market sentiment pretty high. We've seen this before over here when the market sentiment line was high. Here was only above 65 instead of 80 now. But once that intermediate posture dropped below 50, then we were bearish for a while. And again, we're not going to necessarily look for a speculative move to the downside. Just some little bit of bearishness to balance out our active trading portfolio that's probably been pretty bullish here, riding the trend. So here's an opportunity to do that, a stock to do that. So, we'll look. We don't want to, buy puts. They're more speculative, more directional. We're not in a strongly bearish market. It's a weak bearish market. We don't want to sell naked calls because of the unlimited risk. So what we'll do instead is we will sell this 83 call right there and protect it by buying an 85 call. That will define my risk. Give me about the credit I'm looking for. That's a 30% return on risk. When you look at it here, it's a pretty decent odds of success for that trade. The break even here I've thrown onto the charts. On this chart, the break even's back up above that 82.5 area that we broke up above, and it's up here in this 83 where you have some highs over here. So you've got plenty of resistance, and this would include the dividends here. You've got plenty of resistance to hold this down. To hold down any bounce, even in the short term. And we might get that short term bounce. Remember, we're expecting a day or two of bounce, and we might even be able to get a better price in one of these higher strike prices here while we're waiting. So, but as of right now, today, even if it were to bounce up, we got a couple dollars a move to get up to 83, and we got that resistance level there. We can say, okay, get the credit we want for the return on the risk, decent odds of success for that trade. and then look to see if it continues to be bearish because of the extremely low momentum line, as we saw over here, because of the near-term line getting into the reversal zone, which it hasn't done in this whole time we were bullish, and because of the intermediate line getting below 50 with a high market sentiment. So there's an opportunity here to be bearish for a while, especially if crude oil continues to be bearish for a while with a lot of its own macro factors that can weigh on it. So to summarize, we were looking for a little bit more of a near-term pullback, at least a possibility of one. We had some targets in mind. We hit those today, at least on an intraday basis on the S&P and the Russell. Now we'll get that. Now there's that expectation that we'll get a little bit of a bounce. Now granted, anything can happen, but from a market forecast perspective, we may get a day or two or three of a bounce. We would have a weak bearish posture right now, but you can see how the technicals are showing the potential for longer bearish intermediate runs right around that corner. So in the meantime, we can see what's kind of leading the way down. We picked a bearish potential trade idea, a bearish trade idea within one of the weaker sectors during this past week's pullback. And if we continue to show some more extended bearishness despite a short-term bounce, there might be some opportunity there with our trade idea of the day. So thanks again. Have a great one. We'll see you all tomorrow.